What is day trading? Everybody has heard of day trading. Everybody's watched The Wolf of Wall Street. Everybody wants to become a trader, but not a lot of people know what day trading really is. Day trading basically means buying and selling financial instruments within the same day. It differs from swing trading and investing because in swing trading, you're buying or selling, holding a position for multiple days to a week. In investing, like Warren Buffett, you're buying and holding, buying and selling, selling and holding positions that last months to a year to years. So it's different. Day trading is much more on the short term. Take a look at the example we have here on the screen. You can see that we have a sell and a close right there in a couple of minutes, and actually around just 5 minutes of market time. That's a day trade because it only took less than a day for the trade to actually enter and then close. What are some examples of things you can day trade? Really anything. The Nasdaq, the S&P, gold, any ETFs, commodities, you could day trade just about anything. How many trades do you take in a day? I know that's a very weird question to ask because why wouldn't it just be one? Well, you see, day trading has a lot of variables. It changes. The market changes in the small term. So you actually take anywhere from 3 to 7 trades every single day. Whether you have some stops or you just have some profits, it's around the 3 to 7 range every single day. Why is day trading important? Why should you try to become a day trader? Well, there's a couple of reasons for that. The first one is that you have a global community. Just in America alone, there are almost 5 million day traders out there. In the Quantico Cap Discord and actual clients of Quantico Cap, you will meet people that are from Brazil, China, Japan, India. We have people from parts of Africa to Europe to South America. Everywhere there are traders that want to become better and want to become successful. The second reason is that you have the ability to trade anywhere at any point in time. The only days where the markets are closed are national holidays and usually on Saturdays. They don't really close on Sundays because at 6 p.m. the Asian market opens, and then after that is the London market, and then the New York market. So it's a continuous cycle of always being able to trade. And you can really trade anywhere as long as you have a Wi-Fi connection and your computer. That really gives you the financial freedom, and you can become a trader really anywhere you want. And the last reason, and arguably the most important, is that it's the most secure market in the world. The financial market will always be here. There is no getting rid of it. So that means there's always going to be a demand for traders and for analysts. The market will always be here, whether we want it to be or not. It's always going to be here. And that means there's always going to be a demand for traders and for analysts. So if you can tap into this market and actually become good, successful, consistent, you will always have a job anywhere at any time because it's not only the biggest market in the world, it's really one of the most important. Next, we're just going to go through some basic concepts, some things that every trader should know, and some things that are going to make a little bit more sense as you go on throughout the course. If you want to learn more about these basic concepts, terms, terminology, please go to our 7th module, the glossary and vocabulary module. Financial instruments. What are financial instruments? Well, just like what I said, the Nasdaq, the S&P, gold, ETFs. These are the assets you'll actually be trading, like stocks, forex, and like how we do here at Quantico Cap, futures. Each one of these has its own unique characteristics and its own special way to trade. That's why Quantico Cap specializes in futures trading. Then we have the bid and ask price, and that goes along with our next definition, the market price. So the bid and ask price is what buyers are willing to pay for a stock and what sellers are willing to sell a stock for. The market price is the actual price of a stock. Let's say that the market price of a stock is $1. The bid is 99 cents and the ask is $1.01. You can see how there's a difference. The sellers always want to sell it for a little bit more and the buyers always want to buy it for a little bit less. The market price is the true value of the stock. The spread can either be a good thing or a bad thing because it's the difference between the two prices. You're always going to have some type of spread because the market is always going to move. Even though you may exit at $1, the spread, because more people are always bidding and asking, it's always going to be, you might exit at 99 cents or $1.01. So it can either be good or bad depending on your situation. Next up is the margin. Have you ever heard of a margin call? When somebody gets margin called, that's typically the money borrowed from a broker to a trader. So if you only have $1,000 in your personal account, you can only trade with those $1,000. But if you put those $1,000 in a broker, you might now have a bigger margin because they'll let you have a little bit more. So now you can control up to, let's say, $30,000. That's what margin is. And also margin means how much you can go down without actually breaking your account. Then we have a stop loss and a take profit order. Stop losses are orders that you set that automatically closes your trade at a certain loss level. A take profit is the opposite. It's an order that you set that automatically closes your trade in a profit level. Then we have leverage. Leverage means a couple of different things. One, it could be just like margin, where it allows you to control a larger position than you originally have, but it also can increase your risk. Leverage also means the different types of lot sizes and how much you can afford to lose and win. So let's say you have a micro and a mini contract, which are the two most common contracts used in futures trading. A micro contract has a lot less leverage than a mini contract. It's 10 times as less. So you have a lot more leverage and you need a lot more leverage and margin when dealing with a mini contract.